studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
In this slide, we begin exploring one of the more advanced tax planning questions involving dividend income and Part 4 tax. At first glance, the answer may seem obvious. If a corporation has deductible investment expenses available, why not use those expenses to reduce dividend income and lower tax immediately? After all, paying less tax today sounds like a good outcome. But experienced tax planners know that the best decision is not always the one that produces the lowest tax bill this year. That is the central question illustrated in this slide. Imagine that a corporation has investment expenses available. The corporation now faces a choice. The first option is shown on the left side. The corporation can apply those expenses against dividend income. Doing so reduces net dividend income and lowers Part 4 tax in the current year. From a short-term perspective, this looks attractive because the corporation immediately pays less tax. This is what we might call immediate thinking, focusing primarily on the current year's tax return. However, the second option introduces a different perspective. Instead of using the expenses immediately, the corporation may choose to preserve those deductions or create a loss carry-forward that can potentially be used in future years. As shown on the right side of the slide, this approach may not reduce tax today. In fact, it may result in higher Part 4 tax in the current year. But it creates something valuable: future tax planning flexibility. Those preserved losses may be available to offset future investment income, potentially generating tax savings when they are needed most. This is why strategic thinking is so important in corporate tax planning. The goal is not simply to minimize tax for 1 year. The goal is to minimize the corporation's overall tax burden across many years. Notice the fork in the road shown in the center of the slide. One path focuses on reducing tax today. The other focuses on preserving future opportunities. Neither path is automatically correct. The best choice depends on factors such as future investment income expectations, available loss carryforwards, refundable tax balances, and the corporation's long-term tax objectives. The key question at the bottom of the slide captures the entire planning issue. Is reducing tax today always the best tax planning decision? In many situations, the answer is no. Sometimes accepting a higher tax cost today can create greater tax savings in the future. That shift from current year thinking to long-term planning is what separates tax compliance from true tax planning. In the next slide, we'll compare these two strategies side by side and examine the trade-offs between immediate tax savings and future tax benefits. In this slide, we compare two competing tax planning strategies and explore why the lowest tax bill today is not always the best overall tax outcome. Let's start with strategy 1 on the left side. In this approach, the corporation deducts investment expenses directly against dividend income. The corporation earns $20,000 of dividend income and applies $5,000 of investment expenses against that income. As a result, net dividend income falls to $15,000. The immediate benefit is obvious. Because dividend income is lower, the corporation pays less Part 4 tax in the current year. For many taxpayers, this seems like the ideal result. The tax bill is reduced right away, and the corporation keeps more cash in the short term. However, there is a trade-off. By using the expenses immediately, the corporation may lose the opportunity to create or preserve a loss that could have been valuable in future years. In other words, the current year tax benefit comes at the cost of future flexibility. Now let's look at strategy 2 on the right side. Instead of applying the expenses against dividend income, The corporation preserves the expenses or allows a loss position to remain available. In this scenario, dividend income remains at $20,000, meaning Part 4 tax is higher in the current year. At first glance, this appears worse. The corporation pays more tax today, but notice the benefit at the bottom of the panel. The corporation now retains a tax attribute that may be used in future years. If future investment income arises, those preserved losses may be available to offset that income and generate future tax savings. This creates an important planning trade-off. Would you rather save tax immediately, or preserve deductions that may produce larger savings later? The balancing scale in the center of the slide illustrates this decision perfectly. One side represents lower tax today. The other side represents potentially greater tax savings in the future. Neither side is automatically correct. The best answer depends on the corporation's circumstances and expectations for future years. Will the corporation earn investment income later? Will losses be valuable in future periods? Will refundable tax accounts become important? These are the types of questions that experienced tax planners consider before making a decision. The key insight at the bottom of the slide summarizes the entire lesson. The best strategy depends on future income expectations, not just today's tax bill. As tax preparers, it is easy to focus on reducing tax on the current return. As tax planners, however, we must think beyond the current year and evaluate the corporation's entire tax picture. Sometimes a strategy that produces a larger tax bill today can create a much better long-term result. And that is exactly why dividend expense planning and Part 4 tax planning require a forward-looking perspective rather than a purely current year approach. This slide introduces one of the most important concepts in advanced corporate tax planning: thinking beyond the current year. Many tax decisions look beneficial when viewed only through the lens of this year's tax return. However, the real objective of tax planning is not simply to minimize today's tax bill. The objective is to minimize the corporation's total tax cost over time. At the top of the slide, you'll see a tax planner reviewing a multi-year outlook. This reflects the mindset required for effective corporate tax planning. Every decision should be evaluated not only for its immediate impact but also for its consequences in future years. Let's begin with the first timeline, shown in red. In year 1, the corporation chooses to deduct investment expenses against dividend income. This reduces Part 4 tax immediately and produces a lower tax bill in the current year. At first glance, this seems like a success. However, as we move forward through the timeline, a problem emerges. In later years, the corporation has no loss carry-forwards available. When new investment income arises, there are no preserved losses available to offset that income. As a result, future tax costs may be higher than they otherwise would have been. The corporation enjoyed a short-term benefit, but it sacrificed future flexibility. Now let's look at the second timeline, shown in green. In year 1, the corporation preserves the loss instead of using it immediately. This may result in higher Part 4 tax in the current year. In other words, the corporation accepts a larger tax bill today. However, the loss carry-forward remains available. As future years unfold and investment income is earned, those preserved losses can be applied against that income. This reduces future taxes and may produce greater overall tax savings across multiple years. The key difference between the two approaches is timing. One strategy focuses on immediate tax savings. The other focuses on maximizing long-term value. Notice the insight box on the right side of the slide. Tax planning is about lifetime tax cost, not just this year's tax return. That single statement captures the entire lesson of this section. Effective tax planning requires us to think several years ahead. much like a chess player planning future moves rather than reacting only to the current position. At the bottom of the slide, you'll see a practical Part 4 tax planning checklist. Before deciding whether to use expenses against dividend income, a tax planner should review current dividend income, evaluate expected future investment income, analyze available loss carryforwards, consider refundable tax accounts, and calculate the long-term impact of each option. The pro tip at the bottom summarizes the planning philosophy perfectly. Sometimes preserving a loss creates more future value than reducing Part 4 tax today. As tax professionals, we should always evaluate the entire tax picture, not just the current year, because in many cases, the best tax strategy is not the one that saves the most tax today. It is the one that produces the lowest overall tax cost over the life of the corporation.